Good morning, students, once again, and we will practice some problems on straight line method of calculation of depreciation and accounting for the same. Right? We have a problem in front of us. That's problem 1. I'll show you the problem 1. It is very simple. There's an equation and you have to substitute the data in that formula or equation. The problem is purchase price of a machine is 1,80,000 and the freight charges 30,000, installation charges 10,000. Residual value, it's value, it's not whale. Its value is 16,000 rupees and the useful life of the asset is 5 years. Compute the depreciation for the year, for third year, let us say, second year, whatever, he is asking for third year under the straight line method. Okay, the formula is depreciation is equal to cost of machine plus repairs, whatever, or some, incidental expenses, installation expenses, minus residual value, the scrap value at the end of the useful life of the asset. Still you can fetch some value if you sell it as scrap. That's the residual value, scrap value, by the useful life of the asset. Once again, depreciation is equal to cost of machine plus repairs plus installation minus residual value by useful life of the asset. Okay, now we will bring the values from here and substitute in the formula that is given below. Now the cost of machine or price or purchase price, the cost of the machine is 1,80,000. Yes, we brought it here. And there are freight charges, incidental expenses. The transportation of the machine is 30,000 and the installation charges or 10,000. We brought it here, 10,000. Now it is not just the cost of the machine, all the expenses till the machine is made to operate. Okay, all those expenses are included in the value of the machine. It is not the amount that you are paying to the vendor, but all the incidental expenses also are included. Okay, then you will get the total cost of the machine minus the residual value, the scrap value. 16,000 is the scrap value in this problem, and you are deducting 16,000, okay, by the life of the asset or machine, 5 years, right? So 180 plus 30, 210, 210 plus 10, 220,
220
minus 16 by 5,
204.
40,800. 40,800. Okay, right. This is the depreciation, not just for the third year, for every year it is the same. Okay, so now let's look at the second problem. Let's look at the second problem. Now calculate the rate of depreciation under straight line method in each of the following cases. Okay, now there are 4 machines, number 1, 2, 3, 4, and the cost of the first machine is 90,000 and its expenses, incidental expenses, are 10,000 and its estimated value is 20,000. Estimated scrap value, the residual value, the scrap value is 20. Similarly, machine 2, 24,000 is the cost, expenses 7,000, the scrap value 3,100. Machine 3, the cost is 1,05,000, expenses 20,000, scrap value 12,500. Machine 4, 2,50,000 is the cost, expenses 30,000, scrap value 56,000. And the useful life of the respective machines from 1 to 4 are 8, 6, 5, and 10. Now, what I would like to do here is I would like to request Maria. There are 4 machines. I will take 4 people. Maria, then Amar, Pawan Joel, and Sabrinath to take up these four machines and substitute these values in the uh, formula that is given above. Okay, can you please quickly do it and tell me? Okay, so yeah, when we look at this table, this is what we're doing, right? The first machine, 90,000 plus the expenses incurred, 10,000, it becomes 1 lakh minus the scrap value, 20,000. So 1 lakh minus 20,000, 80,000. 80,000 by the life of the asset, 8 years, it gives you, 10,000. That's a depreciation for first machine. Okay, this is the depreciation. Then similarly, when you look at the second machine, 24,000 is the cost and the expenses incurred, 7,000, 24 plus 7, 31,000, 31,000 minus 3,100, the scrap value. Okay, how much? 31 minus 3,100, 28,000, 20, uh, 27,900. Okay, by 6. That gives you 4,650, 4,650, the depreciation value. And similarly, 1,05,000 is the cost of the machine 3, and the expenses 20,000. 1,25,000 is the cost of total cost of the machine, and reduce the scrap value 12,500. Okay, 125 minus 12,500, 1,12,500 by 5 gives you 22,500. 22,500. Okay, the next one, 2,50,000 is the cost of the fourth machine. 30,000 is the incidental expenses or the expenses incurred to make it operative. So 250 plus 30, 280 is the cost of the machine, minus 56,000 is the scrap value. This is the value you can fetch even after 10 years, even after its useful life. Okay, so 250, 280 minus 56, 280 minus 56, maybe 2 lakhs, yeah, I'm sorry, to 1,94,000 around, uh, 1,94,000, 2 lakhs 24,000. Yeah, 2 plus 250 plus 30, 280 minus 56, minus 56, right? So by 10 years, 10 years, that gives you 22,000, 2 lakhs 24,400, and you will get a depreciation of 22,400. Okay, so these are the depreciation values for four machines. The first machine 10,000, second machine 4,650, third machine 22,500, fourth machine 22,400. Right? How do you calculate the rate of depreciation? The rate of depreciation is calculated like this: depreciation by the cost of the asset multiplied with 100. Okay, that is the rate of depreciation. 10,000, okay, 10,000 by the total cost 1 lakh, by the total cost 1 lakh, okay, into 100 gives you 10%. That's a rate of depreciation. This is the value of depreciation, and this is the rate of depreciation. At what rate it is getting reduced? The value is getting reduced at 10%. It is getting reduced. What is the value that is being reduced? The value that is being reduced is 10,000. Okay, next is machine 2, 4,650 is the depreciation, okay, by the total cost of the asset, 31,000 into 100 gives you 15%. At 15%, this machine is getting depreciated. And the third machine, the depreciation value is 22,500 but its total cost is 1,25,000. So 22,500 by 1,25,000 gives you 18% into 100 gives you 18%. That's the rate of depreciation. At this rate, this machine is getting depreciated. And the last one, the fourth machine is costing 2,80,000. The depreciation on that is 22,400. 22,400 by the total cost of the machine 2,80,000 into 100 gives you 8%. This is the rate of depreciation. Okay. So 10%, 15%, 18%, 8%. Right? These are the depreciation values and these are the depreciation rates. Okay. So this is how you will calculate, right? Sometimes there may be a twisty questions like this. Look at this question. A machine is purchased for rupees 7 lakhs. Expenses incurred on its cartage and installation 3 lakhs. These are all total expenses. And the total cost comes to 3 plus 7, 10 lakhs. Okay. Calculate the amount of depreciation at 20% per annum according to straight line method, SLM, for the first year ending on 31st March, for the first year ending 31st March 2015. If this machine is purchased, he's giving some clauses. If this machine is purchased on, okay, clause 1, okay, situation 1. If it is bought on 1st April 2014, 1st April 2014, count April of 2014, May, June, July, August, September, October, November, December of 14, January 1st of 15, February 15, March 15. That means it is being used for all the 12 months, the first machine. The second machine, it is if the second scenario, peradventure, perhaps it might be purchased on 1st July. Okay, let's count. July of 2014, August, September, October, November, December, okay, January, February, March of 2015, all put together 9 months. In the second scenario, the machine is used for 9 months. The third scenario, if it is bought on 1st October 2014, let's count, October 1st, October, November, December, 3 months of 2014, and 15, January, February, March, 3 months of 2015, all put together 6 months. Okay, all put together 6 months. And let us look at the scenario D, a last scenario. If it is purchased on January 1st, how many months it is being put to use? January, February, March. So 3 months it is being used, or it is put into use for 3 months. So these are the scenarios that he's giving. Now let's look at the calculation of depreciation. The total cost, as we discussed, with purchase price of 7 lakhs and the other expense of 3 lakhs gives you 10 lakhs. Okay, 10 lakhs. And the depreciation for this is, okay, depreciation for this is 10 lakhs into 20%. That is 20 by 100. 20% is the rate of depreciation per year. So this is for the entire year. And this entire year, we first calculate 10 lakhs into 20%, 20 by 100. And you will get to, damn, mute yourself.
Class
Okay, yeah, mute yourself. Okay, right, where are we? Now it disturbed us. Okay, right, 10 lakhs into 20%, 20 by 100. gives you 2 lakhs into 12 by, it is used for full year. 12 by 12 is 1. Okay. 1 into 2 lakhs is 2 lakhs. Okay. Right. So the first instance or first scenario, 2 lakhs depreciation for first scenario, 2 lakhs. The second scenario, the second scenario, it is used only for 9 months. 9 by 12 into 10 lakhs into 20%. 10 lakhs into 20%, 2 lakhs. 2 lakhs into 9 by 12 gives you 1 lakh 50,000. 1 lakh 50,000. Okay. Then in the third scenario, it is being put to use for only 6 months. 6 months. Okay. Now calculate the depreciation. 10 lakhs into 20%, 2 lakhs into 6 by 12 gives you 1 lakh. Okay. That's the depreciation for in the second or third scenario. The fourth scenario, in the fourth scenario, okay, it is used only for 3 months, January, February, March. 3 by 12 into 20% of this cost, okay, gives you 50,000. These are the depreciation values: 2 lakhs, 1 lakh 50,000, 1 lakh 50,000. Okay, right. Now, please do let me know if there are any doubts. And we will look into the fourth problem. Fourth problem is accounting for the depreciation. Right. On July 1st, 2012, Granites Limited purchased second-hand machine for 40,000 and reconditioned, repaired or refurbished the same by spending 6,000. On January 1st, 2013, a machine was purchased for 24,000. On June 30th, 2014, machine purchased on January 1st, 2013, okay, this machine is sold for or was sold for 16,000, and another machine was installed at a cost of 30,000 on the same day. The old machine of 24,000 is sold, and a new machine, another machine, it is not a new machine, okay, another machine is installed at a cost of 30,000. The company writes off 10% on original cost. Writes off means provides depreciation or calculates depreciation. Okay. So writes off 10% on original cost every year on 31st March. Show the machinery account. Actually, this is what accounting for the depreciation. Now we are doing where, there are two methods of accounting for depreciation. One is when you are preparing the provision for depreciation account. Another one is when you're not preparing the provision for depreciation account. Okay, now we are looking into when we are not preparing provision for depreciation account. Okay, we are just preparing machinery account. Look at this machinery account. The entry is every time, listen ma, every time the asset comes in, debit what comes in. Every time the asset goes out, credit what goes out. That means when you're buying, debit. Look at this. Granites Limited purchased a machine for 40,000 and reconditioned for 6,000. Okay, so 40,000 plus 6,000, 46,000 is the 46,000 is the value. Okay, 46,000 is the value. And what's the entry? Machinery account debit. Machinery account debit to bank. To bank. How much? 46,000. 46,000. If there's a sale, we will credit it. But in this year, is there a sale? That is in 2012 and 13. 12, it starts with the 30 on the first day of April, ends on the last day of March of the next year, next calendar year. Okay, 1/7/12 means it is, the financial year, let's say, starts with 1st April 2012 and ends on 31st March 2013, right? So this happened in July. Okay, we have recorded it. We have recorded it. Okay, there is another machine purchased in the same accounting period for 24,000. That is also recorded. We'll record that also. Okay, machinery account debit to bank on 1st of January in 2013. It is in the same accounting period. So 24,000, 24,000. Okay. Now this machine is bought on 7th. This machine is bought on 7th. Okay, this machine is bought on uh, January. This is bought in July 2012. This is bought in January 1st. Okay, 2013. January 2013. How many months this machine is used if you're closing the accounts on 31st of March? Okay, this machine is used for January, February, and March, 3 months. This machine is used for 3 months if you're closing by 31st March 2013. Now, this machine is used for how many months? Let's calculate. July of last year, 2012, July, August,
6 months, sir.
September, October, November, December of last year, 6 months of last year, and January of this year, February of this year, March of this year. So 6 months belong to 2012, 3 months belong to 2013. Total number of months used, okay, this machine is used for is 9 months. This machine is used for 9 months. This machine is used for uh, 3 months. Okay, and that is what we had to calculate the depreciation by depreciation or depreciation account. 46,000 is the value. Okay, into 10%. Okay, 4,600 is the total depreciation, but that is to be calculated only for 9 months. So 9 by 12. This is 9 by 12 month. This is not 9 by 20. It is a typing error. So 9 by 12, 46,000 into 10 by 100, that's 10%. Okay, into 9 by 12, because it's used only for 9 months. The value that you get is 3,450. Okay, and the second machine is used for 3 months. Okay, 24,000 into 10 by 100, that's 10% rate of depreciation, into 3 by 12. This is used only for 3 months. Okay, that gives you 600. This is the value of depreciation. So 3,450 plus 600 gives you 4,050. 4,050. It is not necessary you should take like this. Straight away, you can take this 3450 here and 600 here. There's no hard and fast rule to take a total like this. You can take straight away the items, individual items, right? And we will close this account on 31st of March 2013. Okay, the balance on 31st, the balance of the value of these assets that you procured in the month of July of last year and in the month of January of this year, the total worth of the asset you had to know. Okay, what is that? By balance carried down, the closing balance of this machinery, the closing value of this machinery. How much? Total of debit is 70,000, and the highest total we take, that's a convention, highest total we take on both the sides, 70,000, and there is a depreciation of 4,050. Deduct that 4,050 from 70,000, and the balancing figure you get is 65,950. The 65,950 is balance carried down. What is this balance carried down? This is the closing balance of the last accounting period. What closing balance? The closing balance of the machinery is 65,950 for the last year, that is 2013. What was closing last year, that is 2013, 31st March, will become opening for the next accounting year. The next accounting year starts with the first day of April 2013. Write the date 1/4/2013. To balance brought down. Brought down indicates opening. Carried down indicates closing. What was closing last year becomes opening for the next year. And the amount is 65,950. 950. Now calculate the depreciation for next year. That is this year, the current year. This is over. This year became previous year now. Now this year, on 31st of March 2014, okay, in this accounting period, okay, there are no purchases or sales. There are no purchases or sales, right? Okay, so therefore we'll close it. By depreciation. Depreciation on what? On 70,000. It is straight line method. On 70,000, these assets, these two assets are used for the full year. Therefore, we are calculating depreciation of 10% on this 70,000 for full. That is 7,000. And we are not doing these calculations. Why? Because these assets are used for the full year. Therefore, 7,000, right? And what is the value? What's the total of the debit side? 65,950. And the highest total is taken here, 65,950. And what is the depreciation? 7,000. Deduct this 7,000 from 65,950. You will get a difference of 58,950. What is this? The balancing figure. What is that? It's a closing balance. Hence, we write carried down because it is on the credit side. By balance carried down. By balance carried down. What is this by balance carried down indicates? It indicates it's a closing balance on the last day of the accounting year. What is closing now will become opening for the next accounting period. Now the closing date is 31st March 2014, and the same will become opening for the next year. And next accounting year starts with the first day of April. 1/4/2014 is the date we have to write. And we have to write to balance brought down. This is opening balance brought down from where? Brought down from previous year. And this is carried down in the previous year, brought down in the next year. How much? 58,950. Okay. And again, look at in 2014. In 2014, on June 30th, 2014, the machine purchased on January 1st, 2013 was sold for 16,000. And another machine costing 30,000 was installed. Let us look at this. Whenever I told you, whenever there's a purchase, you're debiting. Whenever there's a sale, you have to credit. Buy bank. Here, when you buy to bank, okay, when you're selling, buy bank in bracket sale of machinery, 16,000. Okay, this is opening balance. Okay, this is the sale of the assets, right? Now, as you sold this asset on the same day, what is the date? 30th of June 2014. On the same day, you bought another machine for 30,000 to bank, 30,000 to bank, 30,000, right? To bank, 30,000. Okay, so what is the total on the debit side? The debit side total is 58,950 plus 30. Okay, 88,950. Bring this highest total on the credit side also, 88,950. And there's a depreciation that you had to calculate, right? Okay, there's a depreciation that you have to calculate. Okay, yeah, there's a depreciation you have to calculate. 7,000 is the 7,000 is the depreciation. Look at this. This is note 2, 7,450. How did he get this 7,450? I have missed to give you the calculation, but I'll try to give you the description here. Okay, I'll try to give you the description here. Uh, are you getting me? Hello?
Yes, sir.
You have been signed out. I'm getting a,
Sir,
but
you stop screen.
yeah. Right. So 7,450 is the depreciation on the old machine and the new machine bought. Now look at this. There are two old machines. What you have to do is you will calculate depreciation on 46,000 for full year. Okay, you will calculate depreciation on 24,000 only for the number of months it is being used till it is sold. And you will also have to calculate depreciation on 30,000, okay, from the date on which it is purchased. So the total of these three depreciations is 7,450. Okay, actually I have to show you the calculations here. Okay, 7,450, right? And if you deduct this 7,450, 7,450, and look at this, there is 4,400, there is 4,400. What is this? This is loss on sale. You bought an asset for 24,000, okay, and 10% depreciation is 10% depreciation. If you calculate a yeah, whatever the time used, let's say 6,600 here, and next year you have used it for full year. Okay, so 600 plus 2,400, 3,000 depreciation. If you remove, okay, 24 minus 3,000 depreciation, it comes to 21,000. So yeah, I think calculations may be wrong. Yeah, 24,000 minus the depreciation. Okay, you will get some value that's called written down value, but that is coming around 21,000 change. And the value at which you sold is 16,000, right? 16,000. You bought it for 24, you sold it for 16, right? So this is loss on sale. 4,400 is the loss on sale. You sold it at a lesser price than what actually it is. This is loss on sale. Loss on sale and depreciation are credited. The difference is 61,100. That is the closing balance on the last day of 2015. Okay, and what was closing last accounting year will become opening for the next accounting period. Okay, so that's it, ma. We will stop it here, and
Sir, attendance, sir.
yeah, we'll take the attendance.